Hey guys, this is Randy with Right Side of the Chart. It's Friday, September 16th, 2016. It's 1:45 p.m. Eastern Time as I'm doing this video. I know I've kind of gone video crazy lately. It's just a lot easier to kind of hit on all the salient points versus trying to add those notes in a static chart. So I'll go through this one quickly. Not anything huge going on today, but just wanted to reaffirm that I think the near-term bearish case is still solidly intact right now. I'll go over the charts here. I'm going to start out here with the S&P 500. Um, in the trading room, Shambo just posted a chart of the ES, which made me realize there's a discrepancy in price between the S&P 500 and the SPY, which isn't uncommon. I said there it probably is chalked up to the SPY just going ex-dividend. I haven't verified that, but here we'll look at the charts. There's the S&P 500. This is a SPY. Now the SPY have had this level here for ages. You know, the big red line at that important support level 215.30, which the other Friday last week we took out impulsively, along with that 116 level I've been watching in Qs. That really helped confirm that sell signal. We had a snapback rally on Monday that took us briefly. I mean, these are 60-minute charts, so these 60-minute candles briefly above there, closed there, but gave it up the next day. And you can see how well these support levels, and again, these were identified well in advance, how well they're acting. You can see the SPY. Gap back down right below the top of the 215.30, touch the bottom. So look how many reactions we have so far here. 1, 2, 3, now 4. And it tried to gain that 215.30 level again, and you can see right on there, right how it failed it yesterday, closed right on it. Um, I'm sure that's shaken out a lot of people that shorted this move, and I imagine that's a lot of the short covering when they ramped it up. They meaning the big boys, the markets, they know where the short interest, where it's increased. They know where the stops are placed. All those orders are visible. If you put a stop loss order at your broker, it hangs out on the market. That's an open order for all to see. So the market makers see those, and if they have a cluster of stops right here above 215.30 or above 116 on the Qs, and it's worth their effort to gun the market. In other words, buy futures, buy whatever they need to buy to get up there. They'll do that. They'll take those shares from you, and they'll turn around and then short the market and go back down. That's trading. That's what the trading desks do. You hear about how all these big banks are profitable, how much money they make on their trading desks. They're trading like we are, but with much more powerful machines. Let's just say. And more importantly, the visibility we don't have. How nice would it be able to, if you had one day, if your broker can show you, some numbers where clusters of stops are placed in the market, a real-time short interest, that kind of stuff. One day we'll get there. Anyways, let's not digress. Here's the SPY. This is what I'm talking about. You can see we gapped down today, and we're flirting with that level. Now I had 215.68. To be safe, we've had a few intraday pierces there, so let's just put another line right there to cover the recent lows, that reaction low from Monday morning. That's really what needs to be taken out, and I mentioned that the other day in the market update, both on the SPY and the Qs. So the SPY is threatening that level now, and as I pointed out, the S&P 500 is still comfortably above that level, but by all metrics I follow, the trend indicators. I often talk about my 60-minute trend indicators, simple yet effective. The MACD remains below the zero line and is now curling over. You can see the MACD now curling back down. If you recall, the scenarios I posted before would be to see a reaction high, maybe a lower high if we thrust down, hit this minimum target, another high here. We could put in positive divergence, although we'll see. We may also just slice right through there, burn through these divergences. In that case, it'll be longer down the road before we have a 60-minute bullish divergence set up on the 60-minute charts. So there it is. Bottom line, we are at support on the SPY, and support is support until broken. So although I anticipate a break of that level, and like I said, you want to be safe. You wait for a break of Monday's lows around 212.36, and that's just one index. Now we can watch them all. That gets a little tiresome, but most importantly are the large cap indices, and of those two, the S&P 500 or SPY and the QQQ, which is the Nasdaq 100. Those are the main ones I watch. Again, I already went over this on the update. They managed to clip our stops yesterday just barely. That had to do with the Apple rally, which has since been halted. We'll see where that goes. So Apple single-handedly was the culprit. There was some other buying that obviously spilled over into the markets after rally at Apple, God goodness, trying to get this out quick. After Apple had rallied for several days in a row, we started to see some broad participation, and that really resulted in what looks like a buying climax there, possibly, and we've since reversed. Either way, we're back into the gap now. So they backfilled the gap, they took it out. In the video I said, once we get there, we'll probably run through the gap because that's where a lot of stops are. They're going to take those stops out instead of reversing at the top of the gap, and that is what happened. It went just a hair above where we had the stops. I made mention in the video I was pulling my own stops, but I left it. The official stops are as was. In other words, this trade is stopped out. I need to post an update on it. I made mention in the trading room and the video, I believe. And that's what's happened. So we ran through, gap backfill, ran the stops. We've been moving lower since. Today is quadruple witching. Things could get a little hairy into the close today. And of course, as we all know, we have the big FOMC meeting next week on Tuesday and Wednesday, and they'll announce what they're going to do or not do. But it's more important will be the fact that the market hangs on their every word. So, the futures are still indicating chances that they're not going to do anything. And the markets look out ahead. So really they'll be focused on the next meeting, which I believe is December, if I'm not mistaken, and go from there. So again, it's not what the Fed says or what they do. It's the market's reaction. Don't forget that post-Fed FOMC announcements right after 2 p.m. on Wednesday, it's almost guaranteed you're going to see knee-jerk reactions, usually one or two. In other words, a sharp move up followed by a sharp move down or vice versa. So don't try to take anything from what happens at that point. I usually step back, don't trade that afternoon unless you can beat these high-frequency trading machines, which you really have to get in front of them. You can put an order on one side or the other. But I stay clear of that mess. And then by the end of Wednesday, definitely into Tuesday, the things should start normalizing, and we should have a good idea where this market's going, where this trading range is going to resolve. We had this breakdown, which so far, at least on the Qs, has proved to be a false breakdown because we're still we're back above 116. We're in the trading range. Most importantly, as I continue to say, this would normally be a big red flag to me, and I can certainly say is concerning. Somebody asked today about the semiconductors, which I had said move in largely in synchronicity or in tandem with the NASDAQ 100, the tech-heavy NASDAQ 100. And the success or failure of those trades will largely depend on what the NASDAQ 100 does, what the broad market does. However, the reason I'm still leaning towards a bearish case is the NASDAQ 100, not only is it just 100 stocks, it's also, as I mentioned before, lacking certain sectors. It's very heavy in technology and biotech, doesn't have financials in there. So it's not truly representative of the U.S. economy. The S&P 500 does a better job. The Wilshire 5000 does a better job. And right now I'm looking at the SPY down. The other indices that I follow and trade often are the small caps, IWM, still, in breakdown mode here. They still need to take out some levels to really firm up the bearish case. But point being that, and here's the mid caps. Mid caps are even more important than small caps. There's a ton of companies in here that you know by name in the mid cap arena, and you can see a clear breakdown, a break below this price channel of back test and that 278.80 level, and we're still flirting with those lows that we put in Monday morning. I mean, right there. So the MDY, which is the mid cap ETF, just like the SPY, is threatening to break support. And I don't want to digress here too much, but the fact the S&P 500 isn't, it's a case of the tail wagging the dog. There's so much money into the SPY that a lot of traders will often, trade cues on a breakdown of the SPY. I watch the SPY. I'll watch the S&P 500. You want to be safe? Wait till the S&P 500 takes out the lows. But if the SPY breaks down, that will probably coincide with a breakdown in the MDY, and that will most likely, not guaranteed, but bring the cues down with it and back below 116. What we could do here is put a little trend line. We have this short-term uptrend going here. You can see in the cues. Let's draw it just like this, and that you could probably replicate that a little better on maybe a 15-minute time frame. So these are your support levels. We've entered a gap, we backfilled that gap and then some. So the healthy price action for the cues, if you're bullish or if you're looking to get long or stay long, the cues really should hold the top of the bottom of the gap right here. I'm talking the big gap from last Friday. They should also, well, this trend line would be the first hint of weakness or the first sell signal break of this minor uptrend line. Then you have the top of the gap or the bottom of the gap around 116.50, and of course then that 116 level that defined the bottom of this trading range, the multi-month trading range. So those are levels I'm watching, and we might not have resolution till next week. The other thing, just to wrap up my thoughts here, is typically, now this time may be different, but typically leading up the 2 days, you go into the Fed meeting next week. They start on Tuesday and Wednesday. You won't hear anything till Wednesday afternoon, but the markets tend to go into holding patterns, waiting to see what the Fed does and what they say. So we could have just sort of slog around for the next few days. That is what historically I've noticed, leading right up to the Fed meetings. The other thing is, I posted last week, very timely post. I started it before the market even opened that day, that it's time for the market to throw a hissy fit, which it started to do right on cue. That was on Friday morning I posted. There was that big down day on Friday. And now it started to throw a little temper tantrum there. You can see that, but it snapped back up. So now, historically, if there were any talks, even remote, even though the odds favor the Fed stands tight right now and holds rates steady, if they're ever going to do it, if they're ever going to have the gumption, which most people, and I don't think they will either, have the courage to shock this market by coming out with a rate hike that they didn't talk up and announce well in advance. Anything is possible, and I would just want to say that if they did it, now would be the time to do it, because the market is hovering at all-time highs, right, just under all-time highs, so they have the room. Better to do it now than to wait for the market to, already be down 10, 15, 20% off the highs, because God knows you're not going to do it then. So food for thought. That point being that we have 3 more, not counting today, 2 more hours left in today's trading session, but 3 more trading days, almost 3 full trading days, Monday, Tuesday, and most of Wednesday, until the announcement. It gives the market that long to really show the Fed, hey, you better not, you even think about lowering rates. We're going to sell off, and then you're gonna look bad for raising interest rates. So we'll see. Anyways, we'll see if the market throws a little fit over the next few trading sessions into next week. So there's the pattern we're looking at now. MACD poised to make a bearish cross, hasn't happened yet. Trend indicators flip back, but again, that was only on the cues. I take the stock market as really, it's a collection or a sum of its parts, and the QQQ, as I mentioned, it's only 100 stocks, whereas you have all these, the universe of mid caps, small caps. You have the S&P 500, many other sectors and things like that. Just to wrap it up here, to sort of make the point about the weight that, the effect that the recent Apple rally had on the market, or on the cues, I should say. It's also the top component in the S&P 500, which says a lot, that the fact that the SPY is still down off its lows, despite the Apple rally, shows a lot of deterioration in the S&P 500, or weakness or underperformance, if you want to call it, of the NASDAQ 100. This is the NDXE, the NASDAQ 100 equal weighted index. So this simply applies an equal weight to all the components in the NASDAQ 100 versus using the market cap weighted approach that the regular NASDAQ 100 uses. And you can see here, well, okay, what my point here, trend indicators. I'm looking at the trend indicators. We have just ever so slight whipsaw signals, just barely going into the green. Not enough to really be concerned as of yet. Here's a little whipsaw signal there, red. You can hardly make it out. Um, More importantly, if the posture of the MACD, if this was headed straight up, the RSI was headed up, I would say we'd probably build on the fact that we've recently had this trend indicator, which is just the 13 and 33 EMA pair. It just shows when they cross. Um, I think that'll prove to be a whipsaw signal. At least it's shaping up that way. It looks that way to me. Time will tell. And you can see the MACD signal line just barely, the white line barely above the zero line. Not enough to clearly look in the rearview mirror and say, yeah, this is a confirmed buy signal. Technically speaking, yes, it's undone. Trend indicator went bearish here. The cross with the white line below the zero line, the 1333 here. So you can see it caught that trend, and it's told us we've been on remained on a downtrend. And again, this is not backing Apple out completely, just taking out that overweighting of Apple. And it just goes to show that under the hood, or the point that I'm trying to impress, that Apple, by and large, was the reason this happened in such a move back close to the top of the trading range, where again you look at NDX, the equal weighted NDX, here's the top of the trading range back here, and you can see that we're not even halfway. Looks like we regained, not even at this point, we're not even halfway back up to the trading range. Made it a little bit higher, but we're well below it right now. So that's my analysis, and we'll just have to wait and see what happens next week. Like I said, things may get a little choppy into the close with quadruple witching, but we may or may not have some clues to where this market's going early next week. But by the end of next week, we most certainly or most likely will have a good idea how this whole recent trading range, in other words, will this go down in history as just a big fake out bear trap move, with the market's blasting off to new highs. Anything is possible. It's not my current scenario. Or will this be just a stop clearing, last chance to get in short before the nights drop down? And again, we should know, ideally know later in the next week, the end of next week. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.